This is Current Yield, and I am Jim Grant, and welcome to Grant's Interest Rate Observer of the Year. Joining me today, as always, Eric Whitehead, who is at the podcast control panel, and the great Evan Lorenz, the deputy editor of Grant's. Gentlemen, now welcome to our podcast. Ladies and gentlemen, welcome to our welcome. And Evan, it seems to me we have some timely topics to discuss today. I'm thinking, first of all, the Fed is embarking indeed, and Monday did embark on a year-long listening tour. It's going to find out from the American people what they want out of their monetary policy masters. And that's one topic. And a second topic, of course, might be, Bill Gross. He has opened up to Bloomberg and through Bloomberg to us. And it is, I think the ball is now in our court, is it not?
I think it's only fair.
Yeah. And I should also mention, in addition to these two timely topics, we are sponsored by ZipRecruiter, which is the place to go when you need help. And who doesn't need help? Yeah, who doesn't need help? And we are sponsored also, and not least, by Grant's Interest Rate Observer, which is the kind of the hometown paper around here, and especially by our conference on April 9th, which is going to be merely terrific. And I'll get into the details of that presently. But Evan, first up is the Fed's listening tour. Now, when people listen, do they simultaneously talk?
Not as I understand it. And looking at the Fed, they can't shut up.
No, they can't. Well, I guess if you are holding forth in a podcast, you really can't complain too much about people holding forth. But the Fed, there was a time when discretion was thought to be one of the prime monetary policy virtues. In the old days, the classical central banks, gold standard era, would conscientiously say nothing, but rather let their interest rates and their balance sheet do the talking for them. But now it's kind of the talking monetary system. What are they going to say? Well, what they want to hear is, I think, what they are doing well. And now they say they want a constructive criticism, but Evan, you're a married man, are you not?
Yeah, since 2006.
All right. Now, when somebody near and dear comes to you, and let us just say, hypothetically, that someone has written a sonnet, could happen, and a person says, Evan, would you take a look at this, give it a read, and just tell me what you think. No, don't hold back. No, look, I'm a big person. I'm an adult, and just tell me exactly what you think about this piece of poetry.
That sonnet is awesome.
Yeah, but you didn't read it, did you?
Oh, no.
No. See, I think this is the not-so-transparent theme of this listening tour is we're not going to listen to you. There is a professor, or was a professor at Columbia, Richard H. Clarida, who was a very formidable character, very University of Illinois alumnus, Harvard PhD, most adept at quantitative economics, and does one of these models. He does these dynamic...
Econometric dynamics, stochastic general equilibrium model?
Yes, he is one of the people on that particular project.
Those are the models that famously did not predict any problems in the last crisis, right?
Yes. Well, in fairness to the model builders, they neglected to drop in the financial sector.
That's not important, is it?
No. So former Professor Clarida is now the vice chairman of the Federal Reserve Board. You can think of him, in effect, Evan and Eric, as the Mike Pence of monetary policy. He is there to explain and assent and not to dissent. I think that's fair. So he says, he gave a speech on February 22nd. He said that the central bank is undertaking a top-to-bottom reappraisal of the way it does business. Well, high time, right? We think around here at Grant's.
Oh, yeah.
Yeah. And then he said this. He said, quote, "The fact that the Federal Reserve System is conducting this review does not suggest we are dissatisfied with the existing policy framework." Now, for peace sake. Then why go through the motions? Well, you know why?
No.
No, nor do I. But I gather they are going, this band of merry men and women, they're going to Chicago in June.
Yeah, if I have my dates right, it is, what is it? June 4th through 5th.
4th through 5th, okay. So are the Cubs at home? Eric, are the Cubs at home on June 4th and 5th? Check it, would you? All right. As Eric Whitehead checks the old schedule, National League schedule, I'm going to conjecture that the Cubs are home for two big, fat, sunny day games at sun-drenched Wrigley Field, and that's the reason why they're having this conference there. But be that as it may, they are going to convene people who are knowledgeable about monetary affairs to conduct, to do this kind of survey of the way the Fed's operating.
And did they ask you to attend?
No. I live in New York, though. I don't think the Fed wants to foot the plane fare. I wonder if they asked Jim Bianco.
That is a good question.
Yeah. Eric, when you get finished checking the Cubs schedule, you mind calling Jim Bianco and find out if he copped an invitation to this parlay? Anyway.
Maybe you can bring a +1.
Yeah. Anyway, what did we bring this up for? I know. We brought this up because we do have some constructive criticisms of the Fed. And I think that the better angels of that organization are prepared to listen. I hope they're listening right now. You ready? I've got a couple. First of all, I would like to remind the Fed, this particular Fed, of something that the longest serving Fed chairman said in August of 1955. That was William McChesney Martin, of course. And here's what he said, quote, "We can never recapture the purchasing power of the dollar that has been lost." And this was in the service of setting his face against any positive rate of inflation. And what was interesting about the time of this quote, August 55, wait a second, we got a June 4th and 5th. They're home. They are home. Well, what time does the game start?
7:05.
Sorry?
7:05.
Oh, yeah. Eric says 7:05, so that's a little heretical night baseball at Wrigley. He's still
So I'm guessing the conference ends at 5. That gives them enough time to get uptown.
Yeah, a little, I'm not sure if uptown is a phrase, but you know better than I. Evan went to school at the University of Chicago, as you can tell from his authoritative voice. How about the 5th, Eric? Who are they playing? The Rockies. Well, that could be a good game or two. So anyway, they're in Chicago to see the Cubs-Rockies and also to conduct this kind of show trial about their own fabulous monetary policy. And they're not going to invite Jim Bianco. So we know what Jim's going to say. But here's what we're going to say right now. We're going to say, harking back to William McChesney Martin, that you can never recapture the purchasing power of the dollar that has been lost. And the significance of this quote is, A, he said in August of 1955, parenthetically, the Dodgers were on their way to winning the National League flag. Right, Eric? Yes. And the first ever World Series in Brooklyn. That, however, as I say, is parenthetical. The monetary significance of the summer of 55 was that marked the end of 12 consecutive months, if memory serves, of year-over-year declines in the CPI. Deflation, Evan. And still, Martin comes out and says, we're not going to suffer any inflation because you can never recapture that purchasing power that's been lost. So, well, what we think here at Grants, we have some opinions. And then Evan's going to help us with a fact or two. But our opinions might be boiled down to some of these. That ultra-low, artificially induced interest rates never fail to store up trouble. They facilitate leverage. They promote not growth, but just bigger, fatter balance sheets. And we would opine further that the central bank is playing with fire by actively seeking, as it does, to depreciate the dollar by 2% a year. This is a currency that, whatever its current lofty status in the world, is a piece of paper of no defined value. And finally, or semi-finally, because we're never done, it is our opinion the Federal Reserve should at least consider the appealing course of action of letting the market alone. What are the odds of that one, Evan?
That's so unexciting. I mean,
yeah. So what they are fiddling with now, they're playing this game of tonsil tennis. That's to invoke the memory of Chairman Martin, who was a quite accomplished amateur tennis player. But the Fed is tossing around the notion of playing a kind of a catch-up with inflation. If inflation comes in too low in the recessionary portion of the cycle.
So if they target 2%. So if it comes in at 1%, that means the next year they need to get 3%. So it's kind of a flip of McChesney Martin, where you can never recover the debasement that's happened. It's we need to recover the debasement that didn't happen.
Correct. Now, Evan, have you done some historical research on this for
yeah,
listeners?
I wanted to give this its full shot and see what the Fed's track record has been. So the CPI index begins in 1913, and coincidentally, the Fed begins in 1913. The index at that time was 9.8. Today it is 251.7. And if you do the compound annual growth over those 106 years, that's 3.1%. Now, let's take the Fed seriously, what it's going to do, which is, try to make up for past debasement, or, if inflation's too high, maybe make up for that as well. That means they're actually 1.1% in the good for the next 100 years. So they only need to target 1%.
Oh, that must be great news for them.
Fabulous news. Makes the job easier.
All right. Well, so much for the listening tour. Although, come to think of it, Evan, maybe the Fed had its best listening tour in December.
Yeah, I think it kind of began and ended in December when they turned on CNBC, saw the stock market falling, freaked out, and changed all their plans.
Yeah, so you wonder, I guess you especially wonder, Evan, what would happen to the Fed if it lost its CNBC feed. Anyway, have we finished this assault on the Fed? I never feel as if we're finished, but maybe we can leave some for the next time. Hiring is harder today than it has been in a while because qualified candidates having been qualified, are working for someone else. So this can take a long time. You put out a request for new help, too many applicants, the wrong kind of applicant. This is how ZipRecruiter makes things work. ZipRecruiter.com/grant is the money URL, ZipRecruiter.com/grant. So hiring used to be hard, but today hiring can be easy, and you only have to go to one place to get it done. ZipRecruiter sends your job to over 100 different of the web's leading job boards, but it doesn't stop there. With its powerful matching technology, ZipRecruiter scans thousands of resumes to find people with the right experience and invite them to apply to your job. As applications come in, ZipRecruiter analyzes each one and spotlights the top candidates so you never miss a great match. ZipRecruiter is so effective that 80% of employers who post on ZipRecruiter get a quality candidate through the site within the first day. And right now, our listeners can try ZipRecruiter for free at this exclusive web address, ZipRecruiter.com/Grant. That's ZipRecruiter.com/Grant. I'm supposed to spell out Grant. I can do that. I've had a life experience doing this. Ready? Grant. ZipRecruiter, the smartest way to hire. Meantime,
why don't we announce a listening tour?
Yeah, or a typing tour. We do that every 2 weeks, and it's coming up. We got an issue Grant's due on Tuesday. I think we go to press. In fact, I know we go to press on Tuesday. I would like to say a kind word for Grant's Interest Rate Observer. I know it's a little bit predictable, perhaps, but it indeed is necessary. Now, we're having a conference, our spring conference, at the Plaza Hotel in New York on April 9th. And I'm not going to get into the personalities of the speakers in this very brief public service announcement. I'm just going to talk about the topics. And Evan, I want you to think about these subjects and try to imagine not being present to hear about them, all right? Mm-hmm. Here's one that, so Grant's it's Interest Rate Observer is the name, but eclectic is the spirit, right?
Oh, yeah.
Evan, I love it when you agree. And I'm not going to ask for any constructive criticism either. We can say that for later, like a lot later. Anyway, so we're going to hear about the art market. Now, the art market is kind of a speculative windsock, right? I mean, it tells you what the big shots are doing with their money. And anyway, it is very much a part of the mosaic of present-day speculative activity of the everything bubble. We're going to hear about worldwide monetary disorder, a very contrary take on that. We're going to hear about inflation from the point of view of hyperinflation. How do you start one? How do you stop one? And to that end, we're going to hear more about if our rate of inflation, now settling in seemingly permanently at 2%, might choose to go either down or up in a significant fashion. We're going to hear about today's interest rates in the context of 3,000 years of interest rate history to show how unusual this rate structure is and what the future might hold for it. We are equally going to hear about this notion that, stocks for the long run, stocks for the long run. Got to own stocks, have to own stocks. Well, yes, except is that the verdict of financial history? We're going to hear about that too. Anyway, I can't begin. I guess I have begun to tell you how fabulous it's going to be. And now I'm going to stop telling you how fabulous because I can sense the impatience of the listeners wanting to hear about Bill Gross.
Oh, well, one thing. So we're going to talk about how to start hyperinflation. Are any of the Fed chiefs who are on their listening tour who want to create more inflation coming?
I don't think they've signed up yet, but it's still early days. And by the way, if they are on the road, they started off this listening tour in Dallas, and they kind of, in a showy kind of way, they went to 3 of the poorest zip codes around Dallas and kind of empathized with the poor people and told them that they're all for employment. They think that employment's a good thing. Oh, come to think of it, are they fostering employment with this low interest rate policy?
They would say yes, but we have to look at the consequences of what easy money and low rates actually do. They keep alive companies that are kind of marginally productive, who may barely earn enough money to cover their interest or maybe not cover their interest. These zombie companies tend not to invest. They tend not to hire people. They tend to lower productivity. Low rates also allows bigger companies to acquire smaller companies. And over time, there's been academic research that I know that you've seen that seems to indicate that this leads to lower productivity, lower growth, and kind of lower activity overall.
Yeah.
They bemoan and bewail the fact that we've had low business creation this cycle, that productivity has been declining.
A lack of dynamism.
A lack of dynamism. But they've never really asked, why is this so, and are we contributing to it?
I think that introspection is no more a characteristic of our Federal Reserve masters than is self-awareness. I guess two are related. Anyway, I think it's time for Bill Gross, is it not?
When is it never not time for Bill Gross?
Well, Bill Gross is about to become a non-public person and therefore is soon, in fact, imminently, I guess, to be properly and justly finished with his life's work, which has been very constructive for his investors and I think very gratifying for him. Certainly, it's been one of the great careers on Wall Street. So well done, Bill Gross, who, by the way, in full disclosure, he's been a long-time subscriber to Grant's, and he's spoken at least, I think, one conference at which he's shown. So well done, Bill. Also, he is a swift boat sailor in Vietnam. He didn't talk about that much, but that's also to his credit. So Bill Gross gave this interview with Bloomberg. I think it's on Bloomberg. I think it's probably going to be on YouTube sooner or later. I think it was televised. And Bloomberg says, quote, even after one of the most storied careers in financial markets, Bill Gross has a few surprises left. For one, he's been diagnosed with Asperger's syndrome, the autism spectrum disorder. And Bill's 74 years old, and I'm 2 years behind him. I'm 72, and I'm just going to make this declaration. I don't want to know. I'm not going to go finding out from somebody if I've got some darn syndrome. I expect I do, but I just, it's like your family tree. Do you really want to find out? I mean, I don't know. I guess there's pros and cons. What do you think, Eric? Do you want to find out? No. What good comes of it? Anyway, to me, the interesting thing about this story, about this sharing of Bill's, is that he has totally revised his views on public policy. He now says that he's a near convert to this modern monetary theory business, and he says deflation poses a huge challenge to central banks, and he admires what Japan has done to revive its moribund economy. No, wait a second. Japan has been doing this for 20 years. Is there, let's see, moribunder? I guess more moribund, I guess is the word.
I actually found it funny that he was praising Japan because the Bank of Japan has so interfered with the JGB market, the Japanese government bond market.
It's killed it.
That there's whole days where like the benchmark, like 10-year, will not trade. I mean, that's kind of an issue for a guy who, in his job, buys bonds.
Well, Bill Gross made his career in the world of price discovery, and he is heaping praise upon an organization that has successfully snuffed out price discovery in Japan and is certainly not supporting it outside Japanese territorial waters. Oh, my goodness. I mean, the Bank of Japan buys these ETFs, thereby making a nonsense out of equity valuations. It has destroyed the JGB market. So anyway, Bill finds lots of like in that, and he thinks the U.S. government should consider doubling the size of its deficit. Well, I think that's advice the U.S. government doesn't need. I think that the U.S. government is well on its way to the next recession. I think we're looking at a $2 trillion number next.
I think they already managed to double their deficit last year, almost, in the last.
So anyway, I was flattered and not, kind of fake annoyed when he invoked my name in this interview. He says, he's asked why can't, or I guess he's rhetorically asking, why can't the government have a $2 trillion deficit if the Fed is simply going to buy it like they do in Japan? Gross said, well, Jim Grant would say, it would be inflationary, close quote.
I take offense to that because I've never heard you say to anything.
Right, you can't say Although what people don't know about me is that my first, second, third, and fourth, and 10th drafts have a lot of or the typing equivalent thereof. But I think in fairness to the House view, certainly in fairness to my view, is that, yes, at first I thought these things would be inflationary. That was wrong. That is the QE and allied policies. But I think that I have subsequently come to have the more helpful view that what interest rate suppression and QE do is to disturb the structure of things and to foster the kind of asset inflation that leads to the misallocation of resources, to speculative excess, in particular to the heaping of debt upon debt, and then to a crisis that leads to a further intervention such that the Fed's true dual mandate, Bill Gross, listen please, is that of arsonist and fireman.
And in fact, we've written a lot of stuff on microeconomic analysis looking at sectors like the restaurant industry or grocery stores where too much capital means too many new stores or too many new units or too many new factories get built, and this new capacity actually ends up driving down prices. Right. So perversely, the Fed, in trying to achieve higher inflation, can, in many, many industries, and we pointed this out numerous times over the years, can actually lead to lower inflation, lower returns on capital, lower productivity, and the kind of problems that we're seeing in some academic research is popping up.
And I say the Fed might also have something to do with the tone of our politics, which is another discussion, another podcast. But Uber is talking about going public, right? And it says Wall Street is full of these fabulous numbers, $115 billion initial market cap, some people have been saying. But I think Uber's an example of an enterprise that has benefited by substantially free capital. It's an exaggeration that I think warranted in its substantive facts. Point survives the exaggeration. So think of what happens when these these unicorns get funded with venture capital at very low cost, very low interest rates. Well, they displace others. They create a highly consumer-centric product. We all enjoy standing on a street corner and summoning an Uber and getting whisked away. And
who doesn't love a subsidized product? So Uber loses money on every single ride that people take on it. It's unit economic negative, loses massive amounts of money, which means that we as consumers are paying less than a product cost. Who doesn't love it when somebody gives you money to buy a product?
Well, who doesn't love it are the legacy vendors, in this case, the yellow cab companies.
Yeah, and also public transit. It's actually leading to declines in public transit around the country and around the world, which is actually leading to some actual structural problems.
Yeah. So anyway, Bill Gross, inflationary. But we have made distinctions, and we have, I think, laid out a very substantive and perhaps persuasive case that this nonstop suppression of rates, nonstop meddling, nonstop Batinskyism of these insufferable, self-satisfied, overtrained, undereducated, ignorant sophisters at the Federal Reserve are doing net substantial damage to our republic and to our system of enterprise. That's our line, Bill Gross. And by the way, Bill, congratulations on a great career, and thank you for what you've done for grants. So, Eric, thank you. Excellent work with that schedule. And Evan, thank you. As always, you know what we should do now? We should go back to our desks and type, because that's what we do for a living. This talking business is just, ladies and gentlemen, just a sideline. But I think we have 2 podcasts next week. No, I think we do. So that's even more talking. So thank you for joining us, ladies and gentlemen. This is Jim Grant on behalf of Current Yield, Grant's Interest Rate Observer of the Air.